Good afternoon, everyone. Thank you for attending our webinar series today. My name is Tyson Mavar, one of the Chevron-focused retirement advisors for the retirement group here in Texas. And on today's webinar series, we're going to cover the Chevron pension, some of the decisions that many of our clients have gone through in transitioning into retirement from Chevron related to their pension, both with the lump sum option and the annuity options. Both have their merits. We're going to talk about the pros and cons of the various options today, how they work, some of the implications of interest rates and life expectancy on these benefits, to ultimately, hopefully, help you when the time comes to make this pretty important and irrevocable decision that you've done your due diligence and have the information that you need to make the best decision for you and your family through your retirement. For those of you who aren't as familiar with our company, the Retirement Group is an independent financial planning organization that specializes in helping corporate employees plan for and transition into retirement. Chevron is one of the companies that I focus on and have many clients from. And our hope is that whether or not you do business with us, we give you some information that you find valuable in this decision-making process and transitioning from Chevron. And whether or not you become a client of ours, we hope that you find this information valuable enough to help us grow our business by referring us to some of your coworkers and colleagues before you transition from the company. We have a whole host of complimentary services we strongly encourage you to take advantage of, whether or not you are a client of ours. The cash flow analysis is probably the most comprehensive and will likely give you the most value. It's a complimentary service. We'll give you an idea where you stand today with regards to the sustainability of your retirement plan, and give you our advice on what we think might be some consideration, things you can do before you leave the company to maximize your retirement paycheck and minimize your risk of running out of money in retirement. If you'd like to get in touch with us, we'll give you a way to do so at the end of today's call. We also have a LinkedIn page where we publish these live webinars, so you can go through several of them, any of them that might be of the most interest to you, and at your own leisure, learn more about the retirement process at Chevron, as well as various other retirement strategies that don't necessarily have to do with the Chevron retirement process. So, with regards to the Chevron pension plan, this is what's called a defined benefit program. Keep in mind, in 2008, the company switched to a cash balance plan, which is also known as a defined contribution plan. And that plan is completely different than the heritage plans. There's actually 7 different pension plans at Chevron, depending on where you started your career, what company you started your career with, and the timing of joining Chevron. But the pension plan as a whole has what's called age 65 normal retirement age. To be vested in the plan, you can either be 65 or have 5 years with the company. That just means to get a pension, you need to be at least 65 or have 5 years with the company. Now, there are benefits to continuing to work for the company longer that we'll talk about, and we actually have a more advanced pension seminar that I encourage everybody to watch if you haven't done so yet, going through the formulas of each plan. But it's important to remember, you're going to be on the plan based on when you started with the company. So we have the Gulf plan, the Getty plan, the Texaco plan, the Heritage Chevron plan, Caltex, Unical, and then that cash balance plan that I mentioned. Really important to know which plan you're on and how each plan works, so you can start to figure out the best time to retire, as well as some of the other implications, special benefits that exist on different plans, and then how age and interest rates affect your pension payout, both lump sum and annuity. Now, the lump sum has been very attractive recently, in recent years, for many of our clients from Chevron. Part of that has to do with how low interest rates were for really the last couple decades, although as many of you know, interest rates have climbed very quickly in this last just couple years. So what this is creating is more and more people that we talk to attracted to the annuity more than they were previously, because as interest rates go up, the lump sum payout option is going to go down. The exception on that is if you are on the cash balance plan, your lump sum was not immediately affected by interest rates, although rising interest rates actually help your cash balance grow faster, so it ends up being a good thing for the lump sum for folks that have the cash balance plan. Most of the people that we work with, though, are on the Heritage Defined Benefits plans and have seen their lump sums decrease dramatically in the last couple years. We'll go through each one of these benefit options as each has their merits, and as we get to know you and our clients in going through their cash flow analysis and starting to make recommendations, it'll help us to uncover what might be the best option based on your circumstances, based on your family, the various health issues you may have, your risk tolerance, and some other things we'll talk about throughout the webinar. The single life annuity is the form of payment that all methods, all pension plans equate to. If we go through the formula, you'll notice that all of the formulas equate to a single life annuity and have to be converted to a lump sum, for instance, by using your life expectancy when you commence your benefit, not necessarily when you retire, but when you commence your benefit, as well as the interest rates in effect when you commence your benefit. They also will convert this single life annuity to one of the various other forms of payment options, such as a joint survivor annuity, in which case they will need your spouse or your joint annuitant's age to figure out how much they're going to pay both you and your joint annuitant, depending on those factors. It's a fixed amount. It does not get cost of living adjustments throughout your retirement. And of course, one of the bigger risks that of course we've seen recently is with inflation. If you are stuck in a fixed payment and your cost of living is increasing through retirement, this becomes one of the risks of these various annuity options, the risk of rising prices or inflation throughout your retirement. The joint survivor annuity, more attractive for, I would say, married folks compared to non-married individuals. This is where the company will pay a monthly amount for 2 lifetimes until both you and your joint annuitant, can be usually a spouse but doesn't have to be a spouse, until both of you are no longer living. Now, this payout option, of course, is smaller than the single life annuity because the life expectancy of 2 individuals is longer than that of 1 individual. But there are a variety of ways you can take this joint survivor annuity. You can say, for instance, take a 100% joint survivor annuity, which will mean that your spouse or your joint annuitant will not have a change in their monthly income after you pass away. The detriment of this, though, is that you will get less money during your lifetime in an effort to give more money to your joint annuitant, assuming that you outlive him or her. There, on the other hand, could be an argument to take, let's say, for instance, you are married and your spouse does have a pension of his or her own, but it's a much smaller pension than your Chevron pension. Then maybe you decide to consider a higher payout during your lifetime together, in the case of a married couple, but maybe a bigger reduction during or after your lifetime, given the knowledge that your spouse or your joint annuitant has other resources that can cover their expenses through retirement. That's one example of where a joint survivor annuity might make some sense. We've also worked with clients who originally wanted to take the joint survivor annuity because they were married, but found out there was an argument to do something that's called pension maximization or pension max. This is where you actually take the single life annuity and use a portion of the higher single life annuity payment to purchase a life insurance policy. So effectively, you're still covering your joint annuitant, your spouse in most cases, but you can potentially create a tax-free benefit, a lump sum benefit to your joint annuitant, with also having the ability to cancel the policy in the future. I have a client who retired. His spouse previously had cancer. It was in remission. Originally wanted to take the joint survivor annuity, and we actually found a life insurance policy that was consistent with the increased amount of his single life annuity payout. Is about $300 a month. He paid for this life insurance policy. Unfortunately, his spouse, a couple years into retirement, the cancer came back and she passed away. And as sad as this was, he was very happy that he was able to cancel the life insurance policy and now have about $300 more per month in his single life annuity that he would not have had he chosen that joint and survivor annuity. So there's a lot of reasons to consider the joint and survivor annuity, but we need to know more about your situation, the overall situation, your family, your other resources, health issues, before we can start to come to terms with what's likely going to give you the highest probability of success in choosing this benefit option. Now, first, let's talk about the interest rates, because the lump sum, even with interest rate increases, is still very popular for a variety of reasons. Control is a big issue with a lot of people that I work with at Chevron. Not only control of the death benefit. If you take the lump sum, you can, of course, create beneficiaries that don't necessarily have to be a spouse. If you suffer an untimely death, that creates potentially more flexible death benefit options. Investment, expectation of investment returns is also something that I've seen people lean toward the lump sum, assuming that they can beat the annuity of the company based on astute investment decisions throughout retirement. And some people just don't want to leave their money with Chevron for whatever reason. And by taking the lump sum, you can move it to a different custodian. You can move it to your 401k at Fidelity. You can move it to Charles Schwab, which is our company's custodian, where our clients keep their money. You can move it to an insurance company. You can move it anywhere you want if you take the lump sum. But there are risks of the lump sum, and not everybody is attracted to it. It doesn't make sense for everybody. Before we talk about the other options, though, it's important that we talk about the interest rates and how they affect the lump sum over time. We have a table here showing the interest rates going back all the way to January of 2022 for comparison. The top three rows here are February, January, and December, the most recently available months of interest rate data. You'll see there's three interest rates with each month: first segment, second segment, and third segment. These are correlated with corporate bond interest rates. First segment is short-term rates, second segment is intermediate-term rates, and the third segment is long-term corporate bond interest rates. As it turns out, the second segment rate carries by far the most relevance in this calculation. For instance, the second segment rate is 3 times more relevant in the calculation than the first segment rate. The reason that's important to know is because you may see instances where the first segment rate drops, but the second segment rate increases, and we can actually expect that a lump sum will probably go down even though interest rates went down on the first segment rate. So we pay most attention to the second segment rate as we are approaching the retirement decision with our clients, or approaching the decision to elect the pension, which might not necessarily coincide with their retirement. But look what's happened here. We go back all the way to January of 2023, and at the very bottom you can see the delta, or the difference between interest rates at the beginning of 2022 compared to where they are today in early 2023. Almost a 2.5% increase on the second segment rate. And what that means in plain English is roughly a 25% drop in lump sums for most employees. The rule of thumb that is helpful to remember is that every 1% increase to rates is about a 10% drop in your pension lump sum. This is also a function of your age. The younger you are, the more severe of an impact an interest rate increase is going to have on your lump sum. And the older you get, the less severe this relationship, or less severe an interest rate increase of an impact it'll have on your lump sum. You can also model future interest rate increases in your pension model or through the benefits website and see what your pension payout will be given different retirement dates, as well as different assumptions about a variety of things, the biggest one being what interest rates do between now and your retirement date. Strongly encourage people to assume rates will go up, just to plan conservatively. Fortunately, we have seen a pretty large increase in interest rates in the last 2 years. Hopefully we don't see too much more, at least as it pertains to the lump sum payouts for our folks that are attracted to taking their pension as a lump sum. Something else that's really important to understand about how they calculate this lump sum and why we have the 3 rows on top in white is because the company uses the 3rd, 4th, and 5th month prior to your benefit commencement month in determining your lump sum. To give you an example, if you were planning to retire April 1st, let me say March 31st as a retirement date, with a benefit commencement date of April 1st, your benefit commencement date must be after your retirement date, and it also must be the first day of the month. So if you're wanting an April 1st commencement date, you have to retire on or before March 31st to maintain that date. However, they're not going to use April interest rates, nor March, or even February interest rates. They're going to use January, December, and November interest rates. Not shown on here, but the 3rd, 4th, and 5th month prior to your commencement month is going to be used to calculate your lump sum. The significance of that is we have a bit of a crystal ball when it comes to seeing where rates are going, as well as seeing where our lump sum will be going. And we could, right now, knowing what February interest rates and pretty soon knowing what March interest rates are going to be, decide whether or not we want to retire and or take our benefit versus watching our lump sum deteriorate because of the knowledge that interest rates are going up. Very critical to pay close attention to this, especially when you're close to retirement. And we're delighted to walk you through how to look at these rates on the internet and how to understand the implications of rising interest rates as they pertain to your pension payout and ultimately your overall retirement plan and goals. Now, the lump sum option, like we mentioned earlier, it's the actuarial equivalent of all projected annuity payments throughout your lifetime. The company has to make assumptions on what your life expectancy is going to be through actuarial tables, current life expectancies, depending on your age when you leave. And they also have to make some assumptions of what rate of interest you'd be able to earn on that money if you took the lump sum. This is why when interest rates increase, lump sums go down, because the company expects you to be able to earn more interest on that lump sum, so they just don't have to give you as much money to create the same amount of money as you would get with the annuity, assuming you live to your life expectancy. And we have a good analogy on that on the next slide. Now, on this slide, you'll see that there's no death benefit. That is just as far as Chevron is concerned. You will, of course, have a death benefit if you don't spend all of this money. Like we mentioned earlier, you can roll this over to an IRA, continue deferring taxes for as long as you want until, of course, the government makes you take money out of this account and makes you start paying taxes now at age 73 and potentially age 75, depending on your birth year. And the main reason we see people taking this, I mentioned a couple of them earlier, death benefit flexibility. You can give this money, if you don't spend it all, to anybody you choose. You can make your beneficiaries on your IRA, your spouse, your kids, grandkids, a trust, anybody you wish. Flexibility to invest the money. If you expect to be able to create a better cash flow stream, or if you expect to have a shorter life expectancy. I've seen many people take the lump sum is because they did not expect to live beyond what we found to be the break-even age, somewhere in their mid-80s. If you have a terminal illness, you might not care as much about lifetime payments and care more about enjoyment of the days that you have left. There are risks, of course, with the lump sum, and that's how, the biggest one being how you invest the money. Also, the discipline required to spend that in a sustainable manner, not overspend. And we definitely have had some clients that we had to be the bad guy and tell them through their cash flow analysis that given the rate at which you are spending, we expect you to run out of money way earlier than you expect to live. That's one of the harder conversations I have as an advisor with my clients. And a reason also that I've recommended somebody take an annuity, because I knew their habits and their patterns and did not expect that to be a good route. And the annuity gives you forced discipline. If you're somebody who needs that, that might be a reason to consider it. Another reason that you may consider the lump sum over the annuity is based on the custodian that is handling your money, whether it's a AAA rated insurance company or a very large brokerage firm like Fidelity or Schwab or Vanguard. These are some reasons I've seen people take the lump sum just to want to get the money out of Chevron because of the uncertainty that has to do with any company, including Chevron, over the next 30 to 40 years, however long you live in retirement. So it definitely has its benefits, but it also has some potential detriments that you want to talk about with an advisor that has experience in this, as well as your family, to understand what your values are, and then you can start to back into what's likely going to be the best option for you and your family. Let's go do an example of why when interest rates go up, your lump sum goes down. It could be compared to a mortgage, and this has to do with present value calculation. So what is the current value of a stream of future payments? Well, let's say, for example, you go in last year to buy a home. You run a mortgage calculation on the internet, and based on how much of a budget you have on a monthly basis, let's assume that budget is $19.50 per month to pay for a mortgage, everything included, taxes, insurance, principal and interest. At existing rates were, let's say, 4% last year. And you're looking at a 30-year fixed mortgage. The bank or lender might tell you that you can afford a home that's valued at $408,500. That's the amount of home you can afford. Let's say a year later, interest rates drop to 3%. You still have the same $19.50 per month budget for your mortgage, the same terms, 30-year mortgage, but what happens to the value of the house you can now afford? It actually goes up when interest rates go down because of this time value of money. Same issues with your lump sum payout as a result of a fixed annuity payment. When interest rates go down, your lump sum goes up, and vice versa. When interest rates go up, the lump sum that the company is going to pay you goes down. Now, it's critical to spend some time on this because there are no do-overs in retirement. You got to get it right the first time. And unfortunately, statistically, 74% of Americans over the age of 50 do not have a written plan for their retirement. We at the Retirement Group believe this is absolutely unacceptable. There are a variety of companies, including ours, the Retirement Group, that will put this together for you for free, completely complimentary. The reason we do that is because we certainly would like to earn your business, and by spending some time with us, we believe it will increase our probability of earning your business and increase the probability of you feeling comfortable that we have a good track record in working with Chevron employees through their retirement transition and throughout their retirement. There's no expectation of that. All we ask is that if you spend some time with us and get some value in the conversation, you refer us to some of your coworkers, or at least have some good things to say about us before you leave the company so that we can continue growing our company within the Chevron community. If you'd like to get in touch with us, whether it's to run a cash flow analysis, a Social Security analysis, a net unrealized appreciation analysis, which is a tax strategy for your Chevron ESOP stock, you can email us at info@theretirementgroup.com. You can call us at the home office at 800-900-5867. You can schedule an appointment with one of our Chevron Focused Advisors through this QR code here on the left. And again, that LinkedIn page QR code, if you're not following us on LinkedIn already, highly encourage you to do so. That's where we publish a lot of the content related to different retirement planning strategies we think you can get some value from. Now, we did have a couple questions come up this week, so we're going to go through those. Question 1, with interest rates so volatile on the lump sum, does it make sense to just take an annuity from Chevron? Also, is the annuity insured? So two-part question. With interest rates being volatile, this is only a risk while you are still working at the company and prior to commencing your benefit. Now, interest rates going up is going to probably reduce how attracted you are to the lump sum because it's going to look like a much lower payout. The flip side of that, though, is that you can now go out and buy bonds or fixed income investments, lower risk investments in stocks, and earn more interest than you could have previously. So there's a little bit of give and take there. The reason to take a lump sum versus an annuity is much broader than that. There's a lot of other considerations. We talked about many of them today that we'd encourage you to run a cash flow analysis, do a comparison, talk with myself or one of our Chevron Focused Advisors so we can point out all of the major considerations and shine some light on what might be a better long-term strategy for you. It turns out that there is insurance through an organization called PBGC, the Pension Benefit Guarantee Corporation. This is a federal institution. When a large company goes out of business, we've seen this many times in the past in the auto industry, in the airline industry. We saw this with a massive company years ago that went out of business recently, Sears Roebuck. The PBGC steps in and insures pensions, but not fully. there's a possibility if Chevron was to go out of business and you were on this annuity payment, you were an annuitant, that you could see a reduction in your lifetime income from Chevron. So while it is a risk, it's probably a lower risk for Chevron compared to many companies that don't have as good of funding on their pension plan and aren't as strong of a company potentially as Chevron, but still a risk that needs to be evaluated nonetheless. I'm going to get rid of this disclosure. Question 2. My coworker left last year and she said she locked in her lump sum at a lower rate. Did I miss the window for this rate? Well, we saw some of the rates on the chart. Rates are substantially higher than they were last year, so chances are she got out at a better time than you would be as far as the lump sum is concerned if you were to leave today. Now, that doesn't mean rates could not go back down in the future and your lump sum could go back up. There's other factors in there, such as how much you're making at Chevron, how much you like your job with Chevron. Do you have alternatives to work somewhere else? What's the opportunity cost of staying with Chevron? The opportunity, of course, is your paycheck as well as the variety of other benefits that active employees get. But the cost is what you could be making on your lump sum in an IRA, for instance, that you're not making while that money is sitting in your pension and potentially losing money while interest rates go up. So a lot of considerations there, a lot of variables. Encourage you to call us if you've never ran a projection on your lump sum. We'll help you do so and talk to you about some of the variables in putting that projection together. Question 3. Why do some of my coworkers who also have 23 years of service have a substantially larger lump sum than me? There's a variety of reasons, but the main one usually is because of pay, your pension formula, and it depends also what pension plan you're on, but your pension formula, one of the bigger aspects or variables in that is your pay with the company. The company looks back at your recent years of pay, does an average, and uses that to calculate both your lump sum and various annuity options on your pension. My guess is that they're either making more money than you, or they're on a different pension plan potentially. The Texaco plan was a very robust, very lucrative pension plan. The folks that were on Texaco actually got a reduction in their pension accruals once Texaco and Chevron merged. That could be one example. That's all the questions that we have for today, folks. Thank you, everybody, for spending some time with us today. We hope you all have a good, safe rest of your week, and we hope to talk to you all very soon.